Hello, everybody. My name is Debbie Bannister, and I'm with Exchange Resources. And it's my pleasure to be with you guys today. We're going to discuss the ins and the outs of the 1031 exchange and lots of other details that apply. I just want to go over some housekeeping rules. First of all, we're going to really be focusing, if anybody has any questions, we're going to be using the Q&A section. We're not going to be using the chat. So if you have a question, go into the Q&A, and that way we'll be able to answer your question. If you put it in the chat, we most likely will miss it. So, because we're focusing on the Q&A section. So I wanted to say that. Second of all, when you have questions, if it's pertinent to what we're discussing at the moment or for that section, then absolutely, I'd be thrilled to answer that question at that point. But if you have a question that you're going to be asking that maybe is going to be covered a little bit further down the line, then I may tell you, I'll wait on that one, and we'll handle that as I get to that portion of the presentation. And then when we're done, we're going to have a little more of a Q&A for any other questions that you may have, and I'll be happy to answer all the questions. Okay. What I want to do is get started. We have a few more people joining on, so I'm going to give them just a minute, and I'll get my PowerPoint set up here. Okay, there we go. So we're going to talk about, as I mentioned earlier, the 1031 exchange and all the important things that are necessary for you as a real estate professional, the things that you need to know so you can assist your client so that they can have a successful exchange. Now, we are a qualified intermediary, which is the term that IRS uses for the type of company that handles the 1031. And I'm myself, Debbie Bannister. I'm a certified exchange specialist. And to keep that certification, I have to study the tax code. So I'm pretty current in regards to what the tax code has to say about 1031 exchanges and the things that we can and can't do. But before we start discussing the 1031, it seems that I want to clear up confusion, because it seems like people try to pull in things that pertain to the primary residence with the investment property that's being used for the 1031. So what I want to do is separate everything out. From IRS's perspective, there are really only three types of properties in the United States. So we have the primary residence, we have second home, and we have the investment property. So the primary residence has its own tax shelter, and it's the best deal in town. And that's called, what you see on the screen here, the universal exclusion, or the number of the code is 121 in the tax code. And we're going to talk about this in a minute. The second property is a second home. The third property is investment property. So from IRS's perspective, the only tax shelters they really offer is primary residence, which is what we're going to talk about, and then investment property, if a property is honestly used as a second home. And we're going to talk about this later. When you sell it, you have to pay the tax. There's really no tax shelter to protect it. But we're going to talk about that a little later. So let's talk about the primary residence, and then we'll get this out of the way. If someone lives in a property, the tax code says they have to own it and they have to use it. So owning it's being on title, using it by living in it. And if you own it and use it for 2 years consecutively, or 2 out of the last 5 years, then when you sell that property, depending on your status, if you're married or single, then you will be protected either $250,000 of gain if you're single, or $500,000 gain if you're married. And this is taxed. This is actually not a tax deferral, but tax-free money. So this is great. Like I said earlier, it's the best game in town when it comes to the primary. Any gain that's beyond those thresholds that we talked about will be taxable, whatever the difference. So if you're married and you have a taxable event, you have a gain of $600,000, the first $500 is tax-free. The last $100 you would pay taxes on. So I wanted to bring this up because people get very confused when I talk to the client themselves, maybe not necessarily you guys as real estate professionals. And they get confused trying to do an exchange on a primary residence. And that does not work because exchanges only work for investment property, as we're going to talk about. So it's important to know what the criteria is for the primary residence. And I'm just going over this as a reminder for you to share with your clients if that was the situation. Okay, so now we're going to spend most of the time here now talking about the 1031 exchange and what that actually is. So as I referenced earlier, the 1031 exchange is investment property, applies to investment property. So the tax code actually says, as you see on the screen, that it would be a transaction that involved that a taxpayer would actually trade investment property for more investment property. So the type of properties that qualify are investment property, i.e. rentals, or properties used for the productive use of a trade or a business. That's what the definition of an investment property is. So some people think an investment property may be a property that they've owned, but maybe their son lives in it. They've never collected rent. That actually would be considered a second home. That's not considered investment property. So we just want to make sure we define what type of property actually qualifies for a 1031 exchange. So the question asks, oops, I went a little too far. There we go. The question asks, why then are investors doing this? The thing is, with the 1031 exchange, unlike the primary residence exclusion, this is a total deferral of the taxable event, not tax-free money. So, but the interesting thing when it comes to a 1031 exchange is that people think, as we're going to talk about in this slide, that a 1031 exchange, because you're not paying the tax, that's the benefit. But really, that's a side product. That is a benefit, but the real benefit is what can you do with all the money that you didn't pay to the government? So on this slide, we're going to break down what type of taxes are involved if they did not do an exchange. And then we'll analyze what they can do with that money. They can, if they didn't pay their taxes and did a 1031 exchange and deferred them, then that money that they didn't pay may be a beautiful sum that they can continue on and buy more investment property. So let's talk about the taxes that a person would pay if they did not do an exchange. So there's a few layers of taxation. First thing is if they own the property for a year or less, then they would have short-term capital gains from a federal perspective, and short-term capital gains would be considered ordinary income, and it's based on their tax bracket. So if you have any clients that want to sell investment property and they've had it just for a year, it behooves, or less than a year, it behooves them to try to hold on to it for a year if they're going to pay their taxes and not do an exchange. So long-term capital gains is 15 to 20%, and this is federal tax. This is when you own the property for a year and a day plus. They're on the gain if they make from 80,000 to 400,000 in that window of gain of income, then their capital gains event would be 15%. If they made over 400,000, then their capital gains would be 20%. That's what it is currently. So we have long-term capital gains. The next thing we have that is not referenced here is the state. The state, oh, hold on here. I keep doing that. I keep playing with this button. I'm sorry. So the state is a flat, for California, is a flat rate of 12.3. So you have federal of 15%, then you have state of 12.3, then you have something called recapturing the depreciation, which is not a capital gains tax. It's a federal tax, and it's based on the total depreciation that was taken on since owning that property. So if they depreciated a property, say someone owned an investment property and they depreciate it for $100,000 for over 10 years, then that $100,000 of total depreciation would be separated out, and the taxpayer would pay 25% of that 100K. So that would be a separate tax bill of 25,000 for this recapture that would go to the feds in addition to the long-term capital gains and the state. Okay, so that basically is most of the taxable taxes that'll be paid. There's one more thing that they would be paying too, perhaps, and that is there's a Medicare supplemental tax. And if a taxpayer is married, or let's start with them being single. If they're single and they have a passive gain or gain that's 200,000 or greater, any dollars after 200,000, they pay a separate tax of 3.8 on that money. If they're married, if they have any gain after 250,000, so every dollar after 250, they pay a separate 3.8, and that's for Medicare. So those are all the taxes that are involved. So there's many layers, as you can see. So what's interesting is, a client has the choice. There's a lot of people that may be done and they don't want to invest anymore, and that's fine. They can pay the tax. But maybe what I would recommend is if you have a taxpayer that says, you know what, I'm done. I want to sell this property. It's been a rental, but I don't want to rent anymore. I'm done. I'm tired of being a landlord. Then without you going out of your lane, what's real important is have them talk to their tax professional so they understand and they're not sideswiped by how much taxes they may pay. So I think that's really important. And it doesn't matter if they don't want to do an exchange, that's fine. But if they do, but they make that decision because it's been educated, they talk to their tax person. But if they do decide to do an exchange, these are the benefits. Okay. 1031 exchanges can increase your portfolio of wealth. Now, I had a client way back, early 2000s, that he's still a client of mine, and I love working with him. But he owned, when he came into my life, early 2000s, he owned 60 properties that he started buying in the 70s. He started in the 70s buying a property, then somewhere down the line, selling it and exchanging it. And instead of exchanging for one, he would buy two. And then somewhere down the line, he bought 3 or 4. And he kept doing this through the years, so that when I met him in early 2000s, he had 60 properties that he acquired by means of the 1031 exchange. And what he did is he just kept using this equity that was building in these properties and spreading it out to buy more properties. So at the end of the day, when he came to my life in the early 2000s, his big problem in life was he wanted to sell his properties so that he could retire, because he created his own property management company just to manage his own properties. And he was done. He just wanted to retire. So he was able to sell all these 60 properties into lumps. And he ended up buying into big commercial buildings with property management. And he made a pretty handsome income on his properties. And it was like wonderful, but he was able to do that by means of the 1031 exchange. So his money's still working for him in his retired status. Some people then have an investment property and they don't like it. They're done. Maybe they have apartments and they'd rather just have a single family, or they bought a single family and they'd rather have more rents under one roof. So they'd like to buy a fourplex, or they have a single family and they want commercial. So the great thing about a 1031 exchange is you can change the type of property that you're buying. And by changing the type, it allows you to keep your portfolio fresh for you. So I think that's amazing, because some people may have just own land, raw land. They can actually sell raw land, utilize a 1031 exchange, and buy something that makes an income for them. So changing the type of investment property can be an amazing tool for certain people. And then other people move, and after they settle, they move, they settle, and they want to bring their investment property with them. So this gives them a chance to sell that property, exchange, and then buy wherever they live. And we see that now people are buying and selling all over the US because the 1031 code is a federal code. And so that means you can buy, sell anywhere in the US, and that's what we're seeing. And we see a lot of activity all over the US. Other people have depreciation schedules that they've owned the property for the entire life of that property. And I mean, excuse me, they've owned this property for the entire life of their depreciation schedule. So if you own a single family residence, that property can be depreciated out for 27.5 years. So maybe they've owned this property for 30 years. They've used up their depreciation schedule. They don't have any other tax breaks anymore. So they can sell, they can buy more, they can, and then start a new depreciation schedule and have their tax dollars work for them. And the last two are my favorite of the whole thing. Some people utilize exchanges to reorganize debt. And we're going to talk about that greatly in coming up. But the debt that they reorganize is maybe they have one large asset with a large, maybe they own something for $2 million, but they have $1 million loan on the property. Well, $1 million loan for something like that is 50% equity to, value there that they have. So that may not be bad, but that $1 million loan, the payment isn't large enough to pay for that, the HOA fees, the taxes, the insurance and whatnot. So they would like to sell maybe that larger asset and buy several smaller assets and break that loan debt up so that now they can have properties that provide an income for them instead of maybe pulling money out of their pocket. So 1031 exchange is a beautiful way of doing that. And as an example, I had a client that owned a strip mall at one point, a couple of years ago, and he was just grouchy as can be. And when I was talking to him, I kept thinking in my head, man, I never really get grouchy people. This is pretty sad. And when we started talking, I started understanding what his problem was. And it was this: he had a strip mall. The loan on it was large enough that every single month he was paying $46,000 out of his own pocket to keep this strip mall going. And he got to the point where he was done. He called me, he says, I'm real estate rich and cash poor. I can't afford to do this anymore. So he sold the strip mall, changed the type, as we talked about earlier, bought a whole bunch of single family residence and units and things like that. And, maybe 6 months later, and then another 6 months later, I hear from him each time. He calls me and this man has a whole different countenance. He's happy, and he just loves to call me and report in that his income, his property is actually making an income for him for the first time in his investment career because he reorganized. And to me, that's a beautiful way of utilizing the 1031. And then there's estate planning. So estate planning is something that's amazing too, because people can utilize the 1031 exchange by, I think let me use an example to explain what I'm trying to say here. They use the exchange so that their heirs can inherit a portfolio property or properties in a portfolio that are maybe in their best shape. So let me give you an example. I had this older lady that she was like 96, and she was probably one of my best clients I've ever worked with. She was just sharp and amazing. And she had 3 apartment complexes right next to each other in a cul-de-sac in Buena Park. Her husband died 20 years earlier. And after he died, she'd never put any money into the complex for improvements. She just kept doing repairs, just kept it status quo. So now that she's 96, she realized that she's got 3 grown children, 3 apartment complexes. They were all the same next door to each other on this cul-de-sac. So each of her kids were going to inherit these buildings. But she didn't want them to inherit a heartache and a nightmare because they were all just being run down because she didn't put the money into them. So she decided that she was going to sell, and she was going to take each kid, like kid 1, 2, and 3. Kid 1, she tells him, I'm going to sell this apartment complex. I'm the seller. I'm going to buy something. I'll be the buyer because I'm doing the 1031 exchange. But what I want you to do is pick out what I'm going to buy, because whatever I'm going to buy, you're going to inherit. So I want you to find property that you can manage, because I will pay you fair market value management fees to manage the property while I'm still alive, and then properties that you want to maintain after I die. So she did that with each of the kids. It took 1.5 years to go through this whole transaction. And everybody bought what they wanted, but the mom was the buyer. Everybody got what they wanted, but the mom was the buyer in each of these replacement properties. And the family will addressed that each of these grown people were going to inherit the properties they chose. So 6 months after totally done, she ended up dying. And it was really sad because I worked with her like every day for 1.5 years, and I love that lady. So it was just a very neat experience, because each of the beneficiaries now, the heirs, inherited these properties. And these are properties that they inherited were ones that they chose themselves and they wanted. So this is a great estate planning, because now the thing the mom did not want is her kids to inherit a nightmare. So they all inherited things that they got a stepped up in basis. They could sell and just get the cash, or maintain it and keep it going as investment property. So it just shows you this here, just shows you all the benefits of what a 1031 exchange can do, things that we would know about, and maybe other things we didn't think about, like reorganizing debt and estate planning. Now, we talk about all these great things about exchanges, but there are a few things that don't qualify for an exchange. Oh, there's 3 Q&As. Let's see here. Before I go on, let's make sure. Okay, so let me, Amy asked the question, what would be the tax capital gain for Fed and state if the investor lost 100K and only had depreciation sum? Then in that situation, they may just have to repay recapture the depreciation if that loss could cover their gain. So that's for their tax person, but that loss definitely can offset gain. The second question is, for the investment property, if I later live in as my primary residence for more than 2 years consecutively, do I qualify for the tax benefit 500K and 250? Okay. Let me take a minute and talk about this, and then we'll get back on track, because I wasn't paying attention to the Q&As. If someone did a 1031 exchange and exchanged into investment property, the tax code does allow for them to convert to a primary residence, but there's a few rules that they have to pay attention to. Number 1, they must rent it for 2 years before they make that conversion, because what happens is after 2 years, IRS won't question them. They'll get what the tax code refers to as safe harbor status. And what that means in English is that IRS will not question them regarding the conversion to a primary residence. So very important to know. So now that's the first rule. The second rule is they have to own it for a total of 5 years. So the first 2 years, 1, 2, this was rented. So now they have to live in it for a total of 3 years before this being a total of 5, before they qualify for the primary residence exclusion. So they have to own it for a total of 5. So if they sell it at 5, they get the exclusion, but their gain is prorated by use. So this is important to understand. They don't get that, they get the 500 exclusion, but maybe not all their gain will be used under that exclusion. So an easy way to explain what I'm trying to say is their tax person's going to take the gain from the past to the current and say it's a total of 500,000. And since they owned it for 5 years, they're going to divide the gain into the years owned. So 500,000 divided into 5 is 100K a year. So now the first 2 years that was rented, that is disqualified use because that was rental use. They pay taxes on that 200K, per my example. The last 3 years, that was a primary, 300,000. That is qualified use, and they will have that protected under the primary residence exclusion. So they get 300K protected, 200K they pay taxes on, and then they pay taxes on the recapturing the depreciation. So the longer they live in the property, the more watered down. So if they lived in it for they owned it for 3 years living in it, they pay taxes on 2/5 of that gain. If they lived in it for 10 years and they rent it out for 2, then 2/10 of that gain they pay taxes on. And the rest, just depending, can be covered under the exclusion. Anything after that exclusion amount, they pay taxes on. And if they never sell, like they move in and they just live there till whenever, and they don't sell, then they win at that tax gain. So I hope Amy, I hope Kwan, that answers your question, okay? So then there's one last question. So when we sell investment property in 30 years, do we have to pay flat 25? Yes, if you do not do a 1031 exchange, this is for Harpreet. So his question is, so when we sell investment property in 30 years, do we have to pay flat 25% of recapture depreciation? Yes, that does not go away. When you sell property, and you own it, even though the depreciation schedule has stopped, you still utilize depreciation for that whole schedule. So you have tax benefits that you've had for 27.5 years. So you do have to pay back 25% of that total depreciation. So thank you guys for your patience with the questions. Now we're going to go back to since there's no open questions, we're going to go back to the program at hand, and I'll try to watch. Okay, so now let's get back. The things that we cannot do a 1031 exchange on are the following: stocks and bonds, stock in a trade, which is really inventory if you're selling a business, that doesn't even apply. Partnership interest, which really does apply to us in real estate. Partnership interest is not talking about two separate parties owning an investment property and they're 50% on title, but they call themselves partners because on title, each of them are referenced with their 50%. So that you can do a 1031 exchange on. What they're talking about with partnership interest is in an LLC or some corporation. So if you're doing a 1031 exchange and a corporation wants to do an exchange that owns the property, you cannot exchange you cannot exchange the ownership of the members. It's the LLC or the corporation that does exchange, not the members. Okay. Promissory notes and mortgages. This is another one. So if you have a seller that wants to do a 1031 exchange and they want to carry back a note, the note value is not exchangeable. So it's very important, if they do want to carry back a note, say they're selling for 500, they own it all free and clear. They want to carry back a note for their buyer for 100K, then that 100K would be separated from the exchange. They're going to pay taxes on it. And then the 400 is what they're going to be doing their exchange with. So notes and mortgages and promissory notes are not exchangeable. Some people think they would like to do an exchange, sell investment property and use that money to buy notes. Again, that's not exchangeable. And the last thing that we see a lot of is flipping. People buying properties for the sake of flipping. They want to fix them, sell them, turn them, burn and churn. And this is where we talked about earlier, they don't own it maybe for a whole year, they sell it. Then since that property was used for the full intent of buying it to fix it and then sell it, does not qualify for a 1031 exchange. Even though in the client's mind, that's an investment to them, but that intent is not to hold, it's to fix, fix it all up and to sell, and that intent disqualifies it. Okay, Let's see what we got next here. So remember, we talked about second homes. So we talked about primary. We talked about what investment properties, 1031 qualifies for an investment property. Now, second home. And I said, if it was truly used as a second home, then there's no tax shelters that can work. But there is an unless, as the slide brings out. If they convert this property to a legitimate exchange investment property and they hold it for a rental, as a rental, then it can qualify for 1031. So let me explain. Say I've had a cabin in Big Bear for 10 years. The kids are all grown, they're off in college, we don't use it anymore. Well, then if I start renting this out, even for short-term rentals, and my use is cut back, then it can qualify. So the tax code says that the difference between a second home and investment property is use. So a property qualifies for a 1031 exchange if it's rented out minimally 2 weeks a year, and then you can't use it more than 2 weeks a year. So that's the point. It's rented out minimally 2 weeks a year, but personal use can only be 2 weeks a year, or you can use it 10% of the time, rent it. So you can do whatever's greater. So if I rent that property short-term, maybe VBRO, and I rent it out 300 days a year, then I personally can use that property for 30 days and it's still investment property. But if I live in it for 6 months in a year and rent it for 6 months a year, it doesn't qualify as investment and it's a second home. So now, so understanding that you can legitimately convert a property to an investment property, you just need to hold it for 2 years for your tax returns to show that it has been rented out. And that 2 years could be summed up very nicely in 2 tax returns. So you can show that it's been rented out. Now you can convert it from a second home personal use to investment property, and then it can qualify for 1031 exchange. Okay, let's see, let's go on to the next slide. So now, from this point on, we're going to focus on only investment property. We're not going to be talking any more about the primary or second homes. We're only going to be focused on the investment property, exchanges, and then what you as the real estate professional, the most important things you need to know on how to assist your client. So in the exchange world, there's several types of exchanges that we utilize. The first one is the most common exchange. It's called the delayed exchange. And this is where the timeframes come in, which we're going to talk about in great detail. The next one is the simultaneous exchange, where it used to be this way with 1031 exchanges in the 80s. The taxpayer was forced to close their sale property and the purchase property simultaneously together. That's not the case anymore. Somebody can still do a simultaneous exchange, but it's their choice because of the time frame that we're going to talk about in a few minutes. Then we have what we refer to as an improvement exchange or a build to suit exchange. And that improvement exchange is something that someone can use their proceeds from their sale to buy. So say they sold for $500 all cash. They wanted to buy something. They bought something for $400 all cash, and they had $100K left over, and they can use that $100K for the improvements on the property. So we'll talk about that. That's an improvement or build to suit exchange. And then we have something that's very common now in the market that we've been all living through. It's called the reverse exchange, which allows the taxpayer to buy first and sell later. And we'll talk all about that in detail. So there's another question in the Q&A. So let me look at that. The question is, what was the percentage of use for the second home again? Leah, let's go over that one more time. So for it to be investment property, IRS wants it rented out minimally 2 weeks a year, and you cannot use it more than 2 weeks a year, or you can use it 10% of the time rented, and you can use whatever's greater. So even if you only rented it out for 180 days a year, that means you can use it for 18 days versus the 14 to 2 weeks. So that gives you a little bit more time. I hope that answers your question, Leah. Okay, perfect. Okay, so now let's go on to the next type of, let's talk about, we're going to talk about the delayed exchange in this portion until the very end, where we're going to talk a little bit about the build to suit in the reverse. So now let's put ourselves in the listing appointment. So this goes into what are the things that we really need to talk about when you're taking this listing. So there's a few things, in my lowly opinion, I think is very important, where the questions to ask so that you can understand the needs of your client. So first of all, we know it's investment property. You've done your homework. You were going to, the property that you're going to list. So I think the first thing that we want to pay attention to is maybe ask your client if they don't say anything about a 1031 exchange, because not everybody's aware of it. So if they don't say anything about it, ask them, what do they plan to do with the proceeds from the sale? If they say that they want to do a 1031 exchange, oh no, excuse me, I'm jumping the gun. If they say they want to buy more investment property, then a 1031 exchange would be a good tool for them. So that's the first thing. If they tell you, you know what, I'm sick and tired of having an investment property, I would rather just pay my tax and be done, then those are the clients that you really need to pay attention to. That's a big red flag. And why I say that is they're making an emotional decision, and a decision based on their emotion based versus facts. So when you have a client or a potential client that tells you this, then by all means, give them a homework assignment and make them talk to their tax professional, give them the listing price, guesstimated amount of fees to sell, so that they can find out in advance what their taxable event would be and how much they would have to pay if they did not do an exchange. And this way, they can make an educated decision. And if they can stomach that number and pay the tax, then that's a win-win all the way around. But if they cannot stomach that number, then maybe now they need to look into perhaps doing a 1031 exchange. But what's important here is because I teach a lot of these classes, I get so many phone calls through the years. I've been doing this for 21 years. I'm in my 22nd year. And I get a lot of phone calls from clients that they're from the client themselves, because they told their agent legitimately, so it's nothing wrong with the agent, it's the client, that they did not want to do an exchange. They did not want any more investment property. They were done, and they were adamant. So now what happens is they get their taxes done maybe 6, 7 months later, and they are having a heart attack because the taxes they have to pay are huge and they weren't expecting it. So they call their agent asking for help, and then the agent says, I know, call Debbie, she might be able to help you. So then I get this phone call, which is fine, I'm okay with that. But what crushes my heart is I've had more grown men cry on the phone because they had taxes to pay that were greater than they can stomach. So, and the answer, they call me for help. And unfortunately, the answer to their question is I can't help them because the transactions are done. There's no way going backwards and trying to recreate or save things. Once something's closed, if they don't have an exchange initiated, it's too late. So that's why I really want to bring that up in this portion. If they are very adamant, we respect that, but we want to make sure that they talk to their tax person and find out what that guesstimated taxable event would be so that they can be settled in their skin and it won't be a surprise to them when they file their taxes. So that's my big nugget for the day. Okay, so then what else? It says, what should I look for? And what should I ask my sellers? So another thing I want to look for is, who are the sellers? Is it a husband and wife? Is it in a trust? Is it in a corporation, an LLC? So if it's, a husband and wife, fine. If it's in a family trust, that's no problem, because what I'm looking at is who exactly is the taxpayer. If it isn't an LLC, what I think a good question for you to ask, and again, you're just asking questions so that you can pull information out of them to direct them to the right source for help. And so if they own it in a corporation, like an LLC, then I think a good question to ask is, who are the members of that LLC? If the members of that LLC are just a husband and wife, that's fine. Because we're dealing there, nobody wants separated out. So the husband and wife are going to sell, they're going to buy. The LLC is the owner of the property. The LLC will sell, the LLC will buy. That's fine. But if there's a husband and wife and maybe another couple, and they all are they're all members of this LLC, and that couple thinks in their mind that they're 50% owners, so they want to take their money to buy, and this couple wants to take their money to buy, then this is urgent that you can have them talk to me, or they need to talk to their tax professional, because in reality, the LLC owns the property, not the individuals. So breaking it out, there's no way of breaking it out at the last minute. It takes planning to make that happen. So this is important. If there's other members in the LLC and everybody thinks they can go their own direction, they need to talk to, I would be thrilled to talk to them. They need to talk to a 1031 expert, and they need to talk to their CPA, because there's no way of splitting it out at that time. There's another question in the Q&A. Let me see what that is before I go. Hi, Diana. It says, can you convert a property to a 1031 after the purchase? So you buy a property that was just a property you bought, like for a second home or whatever. I'm just getting an idea, Diana. I'm throwing this out so you can put another thing in the Q&A. So if you just bought a property and it wasn't meant originally to be investment property, absolutely you can convert it to an investment property, and then do a 1031 exchange, but you would have to report it on at least, well, I would say 2 tax returns before you can sell it and do an exchange. So they would want to talk to their tax professional, because their tax professional may say they can just hold it for 1 year, rent it out, report it for 1 year, and then sell it. And then Diana asked, can be a second home, but if someone bought rentals for investment and did not know about the 1031 yet? Oh, so if they have already bought it and they hadn't, then that transaction's done. But then which is fine, unfortunately, that's fine, but then they would report it as a 1031, as investment property on their tax returns, which thus sets the groundwork for in the future, if they decide to sell, now that property qualifies because they're reporting it on their tax returns as a 1031 exchange, and then you can exchange in the future when you choose to sell. But because you bought it not as a 1031 and now it's being rented, even though you didn't buy it as a 1031, investment property, and do a 1031, you still get the same benefits. So you would do your depreciation schedule, get your annual benefit from the depreciation that you're reporting. So you still get the same benefits. But once you start reporting it as investment property, now that sets the groundwork for it qualifying down the line to do a 1031. I hope that answered the question. Let me know if not. Okay, so we're done with our listing appointment. We're asked the questions. We want to make sure if there's an LLC that we find out who the members are. And that is very important because everybody has an idea of what they want to do. And those ideas may not be compliant with the tax code. So it's very important to get that settled up front. Okay, let's see what the next slide has to say. Okay, so now we talked about the listing appointment. We're determining if it qualifies for an exchange, if it was used as investment property, who are the owners, if the person knows about exchanges or not, the potential client, helping them direct them to their CPA to see if they need to do an exchange or not. So we've established that, which is great. Now, the next thing we're going to talk about is we talk about the exchange. They need to buy equal or greater to what they sell. So really, what are the actual economics of the exchange? What are the facts? So the first bullet point says that they need to really buy equal or greater, less the cost than for what they sold. So let's get a mental example. Let's say they sold for $540,000 and they had, and I'm just making this up. It doesn't, there's not real math going on here in regards to fees. But let's just say that the commission, the escrow, the title, recording fee, all the one-time fees, the non-recurring closing costs, let's say that that costs $40K. So now we're down to 500. So in this situation, for a person to totally defer all their taxes and not have a taxable event, they need to buy equal or greater to 500,000. That's as low as they can go. Sales price minus cost of sale. So what that 500,000, that's their net sales price. Now inside that net sales price, they may have a loan for 200,000. And they may have, and so that means they're going to have cash of 300. So the biggest mistake that somebody could do in their mind, and this is what a lot of people think, is that when they're doing a 1031 exchange, it's all about just spending the money that comes out of escrow. And that is not necessarily always true. And I'll explain that in a minute. So in this situation, they sell for 500, their net sales price is 500, they have a $200,000 loan. So to defer all the taxes, they use the 300,000 as their down payment. And then they need to get a new loan equal or greater of 200,000. Now they can buy for 500. Now that's, again, as low as they can go without paying taxes. They can buy as high as they can afford. So they can buy for 800,000, use their 300,000 down payment and get a loan for 500,000. That's greater than what they gave up. So as long as they buy equal or greater to what their net sales price, they're fine. So IRS is looking at making sure that they use all their proceeds and replace that debt. Now, Marion asked the question, assume the same debt, will it include the cash out from the property that the owner took over the last 10 years? Yes. Yes. So the thing is, if I started off and I bought a house for 100K 20, 30 years ago, cash, and then 10 years ago, I took out $500,000 because now it's worth $1 million. I took out $500,000 on a refinance. Then when I sell that investment property and do an exchange, I say we sold it for $1 million now, then I will get 500 cash and I need to get a new loan equal or greater to the loan debt that was on that property at the time of closing. So whatever that paid off amount is at closing, that's the loan debt that I'm replacing. So that's what's important. Now, with IRS, there's another question here. Let me see here. Make sure this is, Marion says, okay. Okay, so Marion, did you hear that question? The answer to that? Yes, that you do need to replace the loan debt. So what's important to understand is that you can replace that loan debt one of two ways. You can, let's go back to my $200,000 loan and the sale price for 500, 300 cash, proceeds, 200 loan debt. Maybe I buy for 500, maybe I just get a new loan. That new loan can be private financing. It could be conventional financing. It doesn't matter, however I get that loan. Or maybe I have enough money in the bank and I want to bring in 200,000 of my money to escrow, new cash. That new cash will offset loan debt. So that's important to know. I can bring in my money to the escrow of the purchase, 200,000. So I bought for 500,000, bring in 200, that 200 replaces that loan, and I use my 300 cash. So that's also something that a person can do. They can totally bring in their own cash to offset new loans. So what's important to understand is that what IRS expects is that all the cash is used and loan debt is replaced if that needs to be. And why I say all the cash is used, some people have this great idea, which I think is a marvelous idea personally, that let's go with my $500,000 example. They had that 200,000 loan to replace. So now they decided to get a loan. They bought for 500, but they decided to get a loan for 300, thus leaving 100,000 extra. So in their mind, they bought equal or greater to what they sold for. They replaced the loan debt. How much better could that be? Well, the reality is the $100,000 extra money left over, they're going to have to pay taxes on, even though they bought equal or greater. So if there's any money coming out of the transaction, they pay taxes on that money. Now, the one more thing that I wanted to bring out is if they sold something and there was no loans on the property and they owned it free and clear, in that situation, then it is all about just spending the cash. So see the difference? They own it free and clear. Their net proceeds are 500. Then it's all about spending that money and making sure they buy something with that 500 or greater. And if they sell something with a loan, then they replace that paid off loan debt. Okay, so let me just make sure there's nothing in the Q&A. Okay, so Marion's all taken care of. Good, thank you. So now those are the economic factors that we talked about. So now we've got the listing appointment. We know what they have to buy for, equal or greater to. So we got the economic factors taken care of. So now let's talk about timeframes. That's just part of that delayed exchange that we talked about, and strategy for the timeframes. So let's just talk about that. So from the close of a sale escrow, the day after closing, we'll start a clock that IRS gives the client to accomplish their exchange. So the clock, there's 2 clocks that start on the same day, the day after closing. So the second clock is called the exchange period. And that gives the client a total of 180 days to buy, close escrow, and be done. So you get a total of 180, which sounds wonderful. And this time frame is really good when people are selling multiple properties or maybe buying multiple properties. So it gives them time to get that all done, and or maybe new construction. So it can help. It says, or April 15th, whichever comes first. So what's important to know is from approximately October 21st till December 31st, April 15th will come before, April 15th will come before the 180 days come. So if a client is selling something in that time frame, and so their escrow closes October 30th, if they need all the 180 days to successfully close on whatever they're buying, because maybe they're buying new construction, then they need to file extension to their tax returns and not file their taxes on April 15th. Because if they file their taxes on April 15th, what will happen is that disqualifies their exchange if it's not complete. So they need to complete their exchange. So they go whatever days they need to get their 180 days. And then after they complete their exchange, they file their taxes. So that means they need to file for an extension. So they need to file for an extension. They don't get an extension on their exchange clock. They just get an extension to file their tax returns. That extension gives them time to finish their exchange clock, finish the exchange, and then they can file their taxes. So that starts approximately October 21st of every given year, and it ends December 31st. Okay. So then we talked about the exchange period. So that was 180 days the day after escrow closes. Now, the first clock is the first 45 days of the 180. And that clock is called the identification period. And what the client has to do is they literally need to identify up to, we're going to talk about, there's two methods of identifying, but they need to identify the property or the properties that they will be purchasing by midnight of that 45th day. And this is, especially in the market that we have now, this is really difficult. So we have two ways of identifying properties. One is called the 3 property rules. So we're going to talk about the rules of identifying. I'm thinking for a moment. Let's talk about strategy, and then we're going to talk about the actual rules. When it comes to helping a client that's doing an exchange and they're working with you to find the replacement property, if it's humanly possible, now I'm not saying it has to be, so don't misinterpret me, but if it's possible, if you're working with them to sell the relinquished property, the property they're selling that starts all this, then can it work out where maybe you negotiate with that buyer a little longer escrow period? What I mean by that is, could it work out where instead of a 30-day, could it go 45 days? The reason why I say that is that little bit of extra time is you're buying your client bonus time before that real clock starts ticking the day after escrow closes. So that escrow period gives the client some bonus time. Now there's some tools that you can use perhaps. For example, Zip Forms has an addendum called the seller's intent to exchange supplement from CAR. And that supplement gives an option on there that you can negotiate with a new buyer, maybe an extension to the close of escrow if need be upfront. And maybe it could be a good tool and maybe not. So I'm not saying this is a tool to use in every circumstance, but it could be a tool that could be utilized somewhere. So if you have a client that you feel that the buyers would cooperate, you could say a 45-day escrow and then maybe an extension of 15 days if they need it. And that extension would only be if needed. So, again, I'm not saying this has to be, I'm just throwing out tools that are there in the event of that you think that it could work. But a little longer escrow buys the client some time. Like, so if you can negotiate a 45-day so that you guys can be out there looking for that replacement property and maybe get an offer and, presenting offers with the hopes that you get an offer accepted even before escrow closes on the property they're selling, if it's possible. Now, if they can, then this is what IRS has 2 rules of how they're going to identify property. So the first rule is talking about the 3 property rule. And that is they have totally a limit of 3 properties. So they sell one and they want to identify 3 because they're thinking of buying 2 and maybe a runner-up, or they want to buy 1 and have 2 runners-up. Well, the runner-up in this market doesn't make sense, but it just, that's what people think. So what I tell clients all the time is, let's not worry about this ID sheet. Let's not even fret about it till we get later into the 45 days. What's important is being out there, helping your client, presenting offers, trying to get an offer accepted, getting inspections done. So by the time you write that property on the client writes that property on their ID sheet, because they're literally going to report up to 3 properties on the sheet that we're going to provide, that they know that once the 45 days pass, that they can close on that property and the guesswork is taken out. So we want to minimize the chance of anything going wrong. So try to get an offer accepted, get escrow open, get inspections done, and then we're going to identify as late into the 45 days as possible that property, so that when the 45 days are up, there's still 135 days left of that time frame to close. So if it has to go later than 45 days, you just want to take all this risk, as much of the risk out of there as possible. And now, if you can close inside the 45 days, you just helped your client have like the perfect exchange, because closed property is the perfect identification. And you close, there's nothing risky, no risk of something falling apart because you're able to close inside the 45 days. Okay, so that's the 3 property rule. There's another rule that IRS offers to some taxpayers, may be the right thing. And that is for people that may want to buy more than 3 properties. So how does that work? So this is called the 200% rule. And what this does, this rule, is that you would actually double the sales price. So say I sell for 1.5, we're not going to deduct commissions, none of that. We're taking the actual sales price. So if I double it, it's 3 million. And I want to take that 1.5 and buy a couple of properties, but I want to see as much as I can get. Maybe I'm going out of state, see what I can get for that money. So if I double that, like I said, the 1.5, that's 3 million. Then I can identify as many properties with a value, and all those values we add up. And at the end, if it adds up to 3 million or less, then that's a perfect utilization of this 200% rule. Perfect. If I identify property and you add them all up and it was 3.1 million, then I just disqualified my exchange if I turn that in. So the point is you got to double the amount or lower. So I could do 2.5, 2.8, whatever it is, but just do not exceed that double amount that I created in this example. And then this may be a way to eke out, maybe that doubled amount. I got 5 properties from that 3 million. I was able to identify up to 5. So that using that 200% rule is a good way of providing an opportunity for the client if they want to buy more than 3 properties. I wouldn't recommend this rule if they're not buying, if they think they're just identifying property, put properties on the list. That it's a waste of energy, in my opinion, because you really want to just identify what are going to be a fact, what you're trying to buy. Because at the end of the day, for the exchange to qualify, you have to be able to close escrow on what's on that ID sheet. So over here, after the 45 days, if the client finds out that they cannot close on anything on that ID sheet, so they pick another property, that exchange will be disqualified. So it's all about using that time, the escrow period, start early, trying to find a replacement property, getting an offer accepted, getting the inspections done, and then identifying more of a fact. Okay, hope that makes sense. If anybody's got questions, let me know. Okay, so this is an example of the 200% rule. They sold for 550,000, times it by 2, they have 1.1, and so they got 4 properties here. They really want to buy. Each of those values are what was published at the time through MLS, or maybe they even went into contract, and it's the purchase price on the contract, but they all added up to the 1.1, did not go over it. So this is a perfect example of an ID sheet for 200%. Now there's nothing wrong if that was 1.1 or 950,000, there's nothing wrong with lower. And so that's fine too. That would still be a perfect example of an ID sheet. Okay. I hope everybody's doing okay. There we go. So earlier in my presentation, I talked about how people can change their kind of property that they have. Maybe they have rental property and vacant land, and they want to change it for investment property where they can actually units or a single family residence that they use as a rental so they can have an income. So people get confused because this verbiage in the tax code is called like kind properties. And they think that a like kind is whatever they have to buy, whatever they're selling, the same type of property. So if they're selling raw land, they're stuck with buying raw land. They're selling commercial, they have to buy more commercial. And that's not the case. So examples of like kind properties actually are opposite of what you would think. Like if you sold land, you can buy commercial, you can buy single family residential investment property. You can sell rental properties for an easement. Leasehold properties, if you have 30 years on that lease plus options, if you need to add options in to get 30 years, then IRS considers that as real estate. Otherwise, it's not exchangeable. It's not considered as real estate. So you can go anything you want as long as it's real estate and as long as it's in the United States. Because as it referenced little below, it says domestic for domestic, foreign for foreign. So if I sold my Mission Viejo property, it does not qualify if I want to go to Mexico to buy property. So it's domestic for domestic. But with that being said, anywhere in the US, there's no problem. You can buy, sell, have combinations of locations in your exchange. It doesn't matter. And if they do own property in Mexico and they want to buy in Costa Rica, then they can do a foreign exchange, and they can do an exchange as foreign property for foreign property. They can't bring Mexico to the United States. They just have to keep that in the foreign part of the world. Okay. So now let's talk about that like kind property, that verbiage. So it's not like kind in the sense that it's the same type of property, but it's like kind with how it's used. So as long as a property is used for investment purposes or for the productive use of a trade or a business, then it qualifies as a 1031 for a 1031 exchange. So what that means is I could sell my single family investment and say I have my own business. I can buy the building that my business occupies. My business occupies it. I did a 1031 exchange in it. Even though it's my business, it still qualifies to do an exchange because it's property used for the productive use of a trade or a business. So it's all about, like kind's all about how it's used, not what it is. Okay, before I go on, there's a question in the Q&A. So let's see what we got going on here. Ed, hi Ed. What's the maximum amount for one replacement property if the relinquished property is 1 million? Thank you. They would use the 3 property rule, and under the 3 property rule, there is the sky is the limit. So they want, it doesn't matter. They don't have to do double the sales price. That's this 200% rule. So they want to just sell one to buy one, then they can buy for 20 million. If they wanted to use their million as a down payment and buy 5 million, whatever they want to do, they can, that works. The only time there's a limit is if they want to buy more than 3 properties and we're forced to use that 200% rule. Then if they identify several properties, they can only go 2 times the sales price. Okay, I hope that answers the question. Let me know if that answers your question, Ed. Okay. Okie dokie. Let's go on to the next slide. Okay, good. Okay, so now remember we talked about in the beginning about simultaneous exchanges. Well, we saw that screen where it showed the different types of exchanges, and one of them was the simultaneous. And the simultaneous exchange, even though it's not forced to be this way anymore, the tax code changed in the 80s by a gentleman, Mr. Starker, which a lot of people hear Starker exchanges because of Mr. Starker. He actually contested his exchange with the tax court, the tax commissioner, because he sold a whole bunch of land to Weyerhaeuser paper to Weyerhaeuser paper, and then he scoured the tax code, studied it, figured out what to do, because there's no way he can spend all the millions of dollars he got for that sale. And he wanted to buy a whole bunch of different properties with that money and do a simultaneous exchange. There's no way that can all happen. So he's, like I said, scoured the tax code, studied it, and then he created a system that he felt was perfectly compliant with the tax code that allowed him time instead of doing all this simultaneously. And so his method was analyzed by, he was audited after he did it, and it was analyzed by the IRS, then the tax commissioner, and he accomplished it. He got single-handedly was able to get the tax code changed to allow us to have this 180-day time frame with the 45-day identification. But the only problem is that he gave himself 5 years to accomplish everything. And IRS took that away and said, yeah, that's not going to work. And that's where we get the 180 and the 45. So TJ Starker is the one that created that. So after that, simultaneous exchanges weren't being forced, and that's the only way an exchange can happen. So now if someone did a simultaneous exchange where the sale and the purchase all closed on the same day or a day apart, then that would be a simultaneous. And now, after that code was changed in the 80s, people started thinking there was no need to work with a qualified intermediary because the sale escrow was going to wire the money directly to the purchase escrow. The taxpayer didn't handle the money. They didn't touch anything. So they felt that there would be no problem with their exchange working if they did not work with the QI because they didn't touch it, the money. So the reality is the tax commissioner that's got involved with one taxpayer that did it. So a lot of taxpayers didn't use the qualified intermediary. It seemed like everything was fine. Then all of a sudden there's in 93, a gentleman by the name of Mr. Gray was audited because he did not use a qualified intermediary. He had that thinking that I'm not touching the money. Escrow A is wiring the money directly to escrow B. I still have an exchange, so be it. So IRS audited him, analyzed it, went to the tax commissioner. Tax commissioner is like the Supreme Court of the tax world. So it ended up with the tax commissioner, and they analyzed it and they came to this conclusion. His exchange was not qualified because he did not, he said, I didn't touch the funds. The monies were directly transferred from escrow A to escrow B. There's no reason why it wouldn't work. And this is what the tax commissioner said. Even though you did not touch the funds, you had constructive receipt or control of those funds because escrow followed on your direction to wire the money directly to escrow B. So this opens up a whole new discussion in regards to how an exchange, the nuts and bolts and why you have to work with a qualified intermediary. Because for Mr. Gray, his exchange was disqualified because he didn't work with one. So if somebody's doing a simultaneous exchange, it's very important that they still work with a qualified intermediary, and the process will happen. The qualified intermediary will actually give instruction for the taxpayer to escrow A to wire the money to escrow B. So the qualified intermediary doesn't even take control of the funds or receipt of the funds, but they have control of where it's going to go. And by doing that, it's in compliant with the tax code. So very important for taxpayers to understand that they still need, if they want an exchange, they need to work with the QI for many reasons. One, the compliance of not having control of the funds is satisfied by working with the QI. And two, all the right paperwork and everything that needs to be done for the structure of the exchange is done by the QI. So before I go on to the next slide, I just want to talk a little bit about what the qualified intermediary does. Because like I said, a taxpayer could go through all the dance. They can sell investment property, buy more investment property, do it within the time frame, buy equal or greater to what they sell for. They can go through this whole dance and do everything right. But if they did not use a qualified intermediary, they don't have an exchange. So qualified intermediary or the QI or the accommodator or the exchange company, whatever terms you want to use, all these are the terms for the people that handle the tax deferred exchange. It's really important to understand that for the client to have a acceptable and approved exchange, they need to work with the QI. Then what happens on your part is the client, obviously outside of getting all the information they need to, like, for example, if you want to talk to me or have me talk to your clients, that's fine. I'll give them all the information they need to understand in regards to how to have their exchange be successful. But then when the exchange company is hired to handle the transaction, regardless who the exchange company is, these are the few things that you need to do. A, for the exchange company to open the exchange, they need to have all the escrow information for the property being sold. Then B, the exchange company will contact that escrow company and get documents, the contract, escrow instructions, prelim, because those documents are what they need to create the exchange agreement and to open the exchange for the client. Then once that exchange is set up with those documents, they're sent out for signatures from escrow. Escrow will have their signature, they attain the buyer's signature, and they also need the seller's signature. So we take care of the seller, get that all taken care of with DocuSign. So the exchange agreement's out. And in that agreement, there's two parts to that agreement. The first part, or actually three parts. The first part is instruction to escrow, so they understand everything that needs to be done from a paperwork perspective. The second part is just a breakdown of the tax code for the taxpayer to understand the rules, time frame, binding liberator, so a breakdown of the code. And the third part is something called an assignment of rights. The taxpayer is actually going to assign the exchange company will be assigned into the transaction, and they're going to join the taxpayer as a seller. And then so that when escrow closes, the exchange company will provide to escrow the wire instructions, and all those proceeds go to the qualified intermediary, the exchange company, and that money's held in a segregated account, waiting for that money to be spent on a replacement property. So thus, that handles the constructive receipt of the fund issue. So the money's come to the exchange companies held in this qualified escrow account that's segregated from the company and from the clients. So that money sits. Then as the buyer, the exchange company is assigned in to the transaction by more documents. So we join the taxpayer as a buyer. And the taxpayers, they're on the contract, they're the buyer. We're just assigned in through the exchange agreement so that when it's time to close, escrow can accept the proceeds that we're going to wire to them so they can have all that money to close the transaction. And, I hear comments constantly from other people, like from clients. They call me and they say, my agent told me, or my neighbor told me that if I do an exchange, it's going to delay everything. It's going to be a nightmare. There's no delay. So as soon as we get contact with the purchase escrow, we get everything set up. We get that money to them a few days in advance so that they have those proceeds to close exactly on time. So an exchange company should never cause a delay in the closing on the purchase. So anyway, so the exchange company will handle all of that, thus going through that dance, setting the documents up, being assigned into the sale so they can receive the money, being assigned into the purchase so they can give the money, doing all the things that we need to do with the documents, with the instructions and the breakdown of the code. That's all in compliance with the tax code to have a successful and a well-structured exchange. And that's what the exchange company does. So they're an extra added party added to the transaction for the sake of the taxpayer that needs the exchange. So I think it's real important to go through, so, for you guys to understand what the QI or qualified intermediary is all about and why they're important to the transaction. Before I go on, I'm just going to answer 3 questions. April asked, I just sold a vacant lot with 3 friends. Escrow closes on 9/3. Could I use that money to help my son buy a rental property? My son's buying around $1 million. My help only about 140. Is that qualify for an exchange? So my question is your son going to be buying this property for a primary residence, or is it going to be an investment property? So, because your portion needs to be for an investment property. April just sent in here. Oh, investment, beautiful. So you can buy with your son, but your portion would represent a percentage. So whatever your whatever your money that you're bringing to the your help would be 140,000. Whatever that percentage is of the 1 million, then you need to be on the deed for that percentage. So let's just say that 140 represents 14%. Then your son would be on the deed for the main percentage, and then you would be on the deed for that 14% as tenants in common. And you absolutely can do it. If you just gave him money to buy that doesn't qualify, you had to actually be on the deed for that to work. But you certainly can make that work if you can get that. You'd have to figure out the percentage, and that certainly can work. Okay, so I hope that answers the question. If you have any other questions, let me know. So that's the one more thing that I want to say before I go on to the next slide. The next slide, we're going to talk about, I think, reverse exchanges. Oh, no, yeah, oops. Ah, there we go. We're going to talk about reverse exchanges and build-to-suit exchanges real quick before we still got a little bit of time. So before we start that, though, what I wanted to talk about is when people bring on other investors. So let's say I sold something for 500,000 net. I want to buy something for $1 million, and I want to take on a partner. So if my partner is going to bring 500,000 to the table, then I could buy this. We can both buy the same property. My partner's not exchanging; they're just bringing money in. But I found this replacement property for $1 million. I can exchange 50%, which is the value of my 500,000, and I would be on title, Debbie Bannister, 50%. My partner would be on title with their 50%. So now we both, between us, own 100%. We'd be tenants in common, and we both then would report on our tax returns. I would report 50% of the property for my investment on my tax returns. My partner would report the other 50 on their tax returns. And you can totally take it on a partner doing that. The problem is not having the percentage right. So if I sold for 800,000 and I bought something for 800,000 and I want to bring on a partner, then there's no room in equity. I bought equal to what I sold for. So the bottom line is, if I take on a partner and they want to be on it for 10% or 20%, then that means that money that represents the 10 or 20%, I'm going to pay taxes on. So we want to make sure that, if you bring on a partner, there's equity above, you're buying greater than what I sold for, and that greater portion is what would be used for the partner. I have another question. Annette, can you explain the build-to-suit? Yes, that's what I'm going to do right now. I just wanted to finish this one sentence on what we were talking about. So if you just add on another partner, make sure there's enough value that you can. Otherwise, for the exchanger, it's going to cost them taxes because it brings down the value of what they're buying equal or greater to. Okay, so now we have the build-to-suit and then the reverse exchange that I want to talk about. The build-to-suit is something that's very interesting, and it may not be for everybody. So between the build-to-suit and the reverse exchange, these are exchanges that are much more complicated exchanges than the traditional exchange. The reverse exchange is basically the most complicated exchange in the tax code. Build-to-suit follows, but it's not difficult for the taxpayer. It's just everything that we have to do to orchestrate it. So let's first talk about the build-to-suit. If somebody earlier in my example, I say that, I sold for 500 cash, and maybe I bought something for 400,000. I have a choice. I can buy something for 400,000, close the escrow, and then pay taxes on that extra 100K. Or I can utilize this build-to-suit exchange where I buy for 400, then this build-to-suit is created. And I'll explain the creation of what we do in a second. But because of the setup of the build-to-suit, once escrow closes on the purchase, then I can start using that 100K for improvements. And those improvements will be paid through the exchange company. They pay upon approval from the taxpayer, the vendors, and the contractor. And now let me explain how this all works. So at the close of the purchase, if someone and this only works for cash transactions, it really doesn't work for lending. and if you're getting a loan. And the reason being is that at the close of the purchase, to make this all work, IRS instructs us to create a corporation. So we create a C Corp, and then we take the property that's being bought and it gets deeded to the C Corp at the close of escrow. So if you're working with a lender most likely will not understand this procedure and will not give you a loan to a shell corporation with no assets that's holding the property, the corporation that's holding the property. So once that property has been parked in, or we call it parked into that corporation, when that escrow closes, then the money that's left over now can continue to be used for improvements on the property without having to pay taxes. Because before, if we didn't have it in that corporation and the closed escrow, then that would be what we call boot, and it would be a taxable event and the taxpayer would pay taxes. So this is IRS is the way around that boot. So if you're doing an improvement exchange, what you want to do is try to get the sale escrow and the purchase escrow to close as tightly together as possible, if it's possible. Because when escrow closes on the sale, you only get 180 days to make those improvements and spend that money from the close of the sale. And the first 45 days, you're going to identify not only the property to be bought, but you're going to identify the improvements with a dollar value to be made. And that all gets added up together. And then that's what you're going to buy. That satisfies your exchange values, buying equal or greater. So for example, I identified my property for 400 that I'm buying. Then I have kitchen improvement, bathroom improvements, and whatever, and they add up to 100K. So now I add that together, and that's 500. So if I spend all that money on those improvements in that time frame, then I successfully have I've deferred all my taxes and did a successful improvement exchange. So if the money's all spent, we pay the vendors, we pay the contractor, and say 4 months later, in about 120 days into the transaction, the money's all spent, then that exchange is done. And we deed the property back to the client and we're done because the money's been spent. If they make it to their 180th day and there's still 20,000 in their account, then on the 180th day, we have to deed that property legally to the client. So the property gets deeded back to the client. And then whatever money's in the exchange account, that becomes a taxable event. So instead of paying taxes on 100K, now they're only paying taxes on 20K. So it minimizes their taxable event. So build-to-suit can be a good tool for some people. And other times I think it's important for the taxpayer to talk to the client. Talk to their tax professional, because can these improvements that they're being made offset this gain? Is it better just to do a partial exchange and have 100,000 that we as the exchange company is just going to say you're going to pay taxes on? But then when you go talk to a tax professional, since there's capital improvements being made on the replacement property, can that offset the gain of the 100K? So it's important for the taxpayer, the client, to talk to their tax person so they can find out if a build-to-suit is of value to them. Okay, I just saw a question from Leslie. What was the time frame from the build-to-suit to spend the money? From the close of the sale property, they have a total of 180 days to make those improvements. So that means you got to get the purchase property, if possible, closed as close, maybe simultaneous to the sale, or as close to the sale as you can, so that you can have as much of that 180 days for the improvements. And if you can do that, then that's great. Otherwise, sometimes the improvements are not that big of a deal. Maybe they're doing a couple bathrooms and maybe floor coverings, and they can get that done in 2 months. So if you're closed escrow on the purchase, 60 days into the 180, you still have time to get it done. It just matters how much work needs to be done and how much money needs to be spent. And what I did not say is that you cannot just, build a suit exchange for it to qualify for money to be spent on the property. You can't just buy material and have it dropped off. So for example, maybe you're doing a whole new build and you want to buy all the roofing material, but you don't even have the walls up, and you just pay for the roofing material. That does not qualify, because IRS wants to see whatever building is done is actually done to the property, and that money spent legitimately on things that have been installed in the property. So that's very important to know. Okay, so there's one more question here. Let me see in the Q&A, and then we'll talk about reverses. April says, another question is, my son, difficult to find the house he likes. Could I keep my money in escrow, wait for might more than 6 months until he finds a house to do escrow, to do an exchange? If you're doing a 1031 exchange, no, you're stuck to that. Well, if you don't close escrow, then the timeframes don't start. But once escrow closes, then you're stuck to the 45-180 timeframe. But if it's an escrow for a long time, then so be it. But once escrow closes, there's no way around the timeframe. I hope that helps, April. Okay. So now let's talk about the reverse exchange, and then we'll take any other questions that you guys have. So the reverse exchange is probably been one of the most useful tools in the market that we have now. But it's a hard one for the client for a couple of reasons. First, the reverse is about buying first, and then after the close of the purchase, they have 180 days to sell what they have to sell. Thus, they can be reimbursed from the exchange funds, from the sale of that property. Those proceeds can be used to reimburse the taxpayer whatever money he used to buy. So in the reverse, the hard part is, Deborah wants to know if there's a new slide. Actually, you know what, Deborah, you guys, for some reason, I've uploaded the wrong presentation that didn't have the reverse. So if you want, I'll show you my email address in the end, and I will give you information about build to suit and reverse exchanges it's good information. I can email you some information about that so that you have it for your reference. Okay. Before I get any farther into the reverse, let me see, there's another question here. Can you refresh? Yes, Johnny, I will do that. There's no new slide. And Nancy, the 45 days is monitored by the qualified intermediary. IRS puts that responsibility in our court, and we monitor it. And if we don't monitor it correctly, it will literally, IRS could use that as a basis to shut us down. We have to make sure we handle the monitoring of that, of the 45 days properly. So Johnny and everybody's asking me about the slide presentation. I actually uploaded the wrong presentation that is missing the last 2 slides. I don't know how or why. So again, you can put it in the Q&A, your email address, or text me to my phone number, which is 714-269-1285. That's 714-269-1285. And I will give me your email address, and I will send you information about the build to suit and the reverse exchange to you. I appreciate that. So thank you guys for your patience with me. Okay, so let's talk about the reverse. So I said that it could be hard on the taxpayer for 2 reasons. One reason, they need to have the money to buy. So however, whatever they do, they may just have enough money to get in it with a higher loan than what they would have done if they would have sold first. But so they need to get money to buy, have the ability to buy. The second is that it's a more expensive transaction because of the stuff I'm going to explain to you. What we need to do, our fee is a flat fee of $8,000 to put this whole thing together. So what happens? So the client, if the client doesn't utilize the process I'm going to explain, if they buy something, close escrow, now they own what they want to sell. They own everything now at the same time, and IRS won't allow you to do an exchange on what you own. So to circumvent that issue, the reverse exchange procedure was put in place in the year 2000. And what IRS requires, according to the tax code, is that we create what they refer to as a corporation that we would use to park either what they're selling or buying in that corporation. This corporation is called an exchange accommodation title holder. And what that means, and that's you, oh, excuse me, we use the acronym EAT, EAT, for the name of this corporation. So IRS requires that we create, or EAT is created. So we have a beautiful legal department. We create our own corporations. We create C Corps. Then we decide which is the best property, the property they're selling, the property they're buying, which is the best choice to park in this corporation. If they're selling with, if they're buying with financing, then we're going to park the property they sell, because we're back to that, a lender who's going to give them a loan and a shell corporation with no assets. So this parking arrangement, if they're getting a loan, lenders don't understand it. So we don't mess with it. We take the property they're selling and we're going to deed it to the corporation. We do this about 2 days before escrow closes on what they're buying, on what they're selling. So we make it really tight. We make it very tight because the day after parking this property starts their 180 days to sell what they have to sell. So we don't want to start that clock prematurely. So we get it right at the end so that it all coordinates close to that close of escrow on what they're buying. So then now for the reverse, we've parked the property they're selling. So when that property eventually, they have 180 days to sell. So eventually when that property sells, then the taxpayer gives the corporation instructions on what to do with those proceeds. Then we take those proceeds and pay back the taxpayer the money they spent out of pocket. And if there's money left over, then that extra money can be used to pay down loan debt if need be. Because this way we'll make everything right as if they sold first and then bought. But of course, as you know, it's in reverse. So if they bought greater and that loan, it's going to be, that loan debt's a little higher and they have money to pay it down, then we're going to pay down that loan debt. So at the end of the day, when all the money's been returned back, then we file a tax return as an extra added precaution for the taxpayer to show that they've done everything, to prove to IRS that everything was done exactly the way it's supposed to be. And then we dissolve the corporation and that exchange is done. But there's a lot of legal documents that are created. So this exchange is done solely in our legal department. So for example, the property that's being parked, if they're buying with cash, we park the property they're buying. If they're buying with financing, we park the property they're selling. So regardless, whatever property we park in that corporation, we supply a note and a deed of trust to the taxpayer for the equity position of the house or the property that we're holding in that corporation. And this is an extra added layer of protection for them so that when it is sold, then that note is dissatisfied and that property then is sold to the new party and the client was protected and that note and deed of trust have been reconveyed and it's done. So we also have in their management agreements where if we are holding the sale property or even the purchase property, we don't want to manage. So we also put management agreements that the taxpayer is going to be the manager, the taxpayer is going to collect the rents, and we're not going to be involved in all that. So there's all these different agreements that are prepared to facilitate who manages and the protection of the taxpayer. So the reverse exchange can cause a lot of relief, I guess, for the taxpayer, because if they have a lot of money to spend, so maybe they sold something for 1.5 or greater, and their taxable event would have been huge. Maybe their basis was very low and they have a lot of taxes to pay. If their exchange was not successful, then it behooves them to try to utilize the reverse so they can spend their time and not just have 45 days from the close of the sale, but spend all their time looking for the replacement property. And then once they find that replacement property, they get an escrow. They don't have to have contingencies. If they have cash, they can just buy all cash, however that may be. So then it could be an easier and smoother transaction. And then we set up the reverse before that's closed. Now, some people utilize the reverse for a few reasons. One, maybe they found the replacement property, they're in escrow simultaneous with the sale property, the replacement property, everything's going fine, and the buyer falls out of escrow for the sale property. So the taxpayer wants to move ahead. They don't want to lose out on what the property they found. So a lot of times that will convert to a reverse. Other times a reverse is good. We call a hybrid exchange when maybe they're selling more than one property. So maybe they're selling three. Two properties sold great, and they can use that money as the down payment for a replacement property that they have the normal 180 45-day clock. So they use that as a replacement property, but the third one didn't sell. So before escrow closes on purchase, we'll set up the reverse. So now that gives another 180 days for that sale for this third property to sell. And when it sells, then we use that money again to either pay back the taxpayer or pay down loan debt that shouldn't have been. So that's a hybrid exchange. So that's a very popular exchange when people are selling more than one property, because not all the time do all these properties sell at the same time and everything come together as smoothly as we want. So that's really a great method of making everything pull together. Thus, it gives them a little bit longer of a time frame, because that extra property that we pick up to do the reverse with, we start the clock over again. So they get another 180 days for that sale. So the reverse can be a beautiful tool for the right person. Like I said, it's not for everybody, but for the right person, it can be the best tool ever. So now let's see here. There's a few other questions that are going on. Oh no, that's good. I just wanted to double check to see if there's any questions in the list. Does anybody have any other questions for me? We're pretty much at the point where I can take your questions. We're pretty much done with the things that I wanted to talk about today. The one thing that we didn't talk about that I would like to share is that multiple properties in an exchange is very common too. So if somebody wants to sell one larger asset to buy two, it's the cumulative value of what they're buying that adds up equal or greater. So they definitely can sell one and buy more than, buy two, three or more, or maybe sell, like I have a client right now that's selling 8 properties to go into one big one. So you can reorganize your assets that way too when it comes to a 1031 exchange. Okay, so is there any other questions that anybody has? We've got a few more minutes on our clock. So what I'm going to say, just for some housekeeping things, is that the people that sent me a text, I will absolutely email them some information on, just let me know. I'll email you information on reverses, build a suit, or if you have any other questions you have. My email address, if you like that too, is D Bannister at exchangeresources.net. So it's D Bannister, BANNISTER at exchangeresources.net. And you're very welcome to email me, and I will give you whatever you would like in regards to the, I'm looking to see if my email address is here. I don't have my email on here. Okay, so I'm very, very happy to email you. So it's dbannister at exchangeresources.net. We got a few more questions. What's this the phone number again? My phone number is, Leslie, 714-269-1285. That was 714-269-1285. The next question is from Nancy. When I'm speaking with a seller, do I care how much equity they have in the home when discussing the 1031? Not necessarily, because really for the taxpayer and for you, what's important for you to know is they need to buy equal or greater to what they sell for. So the equity in the home is, that could be a conversation I have with the taxpayer, but it's not necessarily that important for you because they just need to be equal or greater to what they sold for. So what I say, Nancy, is if someone thinks they don't have that much equity and they're wondering if an exchange is worth it, then that is your cue to give them a homework assignment to make them talk to their their tax preparer, or their accountant. Give them their listing price, a guesstimated amount of sales, the fees for selling, the non-recurring, and then have them talk to their tax person to see if an exchange is of value. Because maybe their equity is low enough, they're not making that much money and they don't mind paying taxes on it. So, so that's really important. Okay, so the question from Annette is, how much are the fees for accommodators in general? Our fee is a flat fee of $950, and that covers one sale and one purchase. If you broke it in half for each side, it's $475 per property. If there's extra properties added to the exchange, then we charge $250 for any additional property added. So I think the $950 is pretty common fee among accommodators. So some of them may be $1,200, some of them may be, $800, but they're all pretty close. They're not too far from each other. Okay, so Amy says, can you send me your email address, please? Can I subtract my loss from? Okay, Amy, yes, I will send you my, if you text me, my number is 714-269-1285. Text me and I will send you my email address. That way, text me your email address or just text me and I'll send you my email address, whatever. Okay, so that's that. And I think that's done with that question. So if there's not any other questions, you guys know how to get me. If you have any other questions, it'd be my pleasure. If you have clients that have things that are popping up, like owning an LLC and people want to separate out, or people don't understand what they need to do, it's really my privilege to be able to help them understand how the 1031 works, what they can and can't do. Nothing's worse than somebody thinking in their head they can do something and then find out later they can't. So early from the listing process, that's the time to really get a lot of these questions answered for them. If there's not any other questions, I really enjoyed my time with you guys today. And I look forward to working with you and helping you with your clients.
Thank you so much, Debbie. Also, I did put your email address in the chat. So if everybody references the chat, you'll see her email there. It's dbannister@exchangeresources.net. And we also have the list of those that attended and registration list, Debbie, for you. So if there's anything else that you would like to send out to the group, just email Cassie and we'll make sure to include it in the email listing for everybody.
Perfect. I will do that. And I do have a little gift for everybody being here. I have a property analysis worksheet that I'll send out to everybody that you can give to clients so they can see if it's what they own, if it's worth, if they can, so they can see the facts on what their property is really doing for them. Is it really making money for them? So it'll be a little gift that I'm going to give to all you guys. Okay. Thank you. Okay. Thank you guys very much.
Thank you. Bye-bye.
Bye.